in a crude laboratory in the basement of his home.
Welcome to the CEO Rater podcast. It's your host, John Mayetta. Had the pleasure of interviewing Bill Stone this morning. Bill is the founder, chairman, CEO of SS&C Technologies, ticker symbol SSNC. I first had the occasion to meet Bill in SS&C back in 2009, 2010, back in my investment banking days. And an investor friend had recommended that I get to know the company. This particular institutional investor told me that nobody knows financial technology better than Bill Stone. At the time, I was building out equity research coverage of the financial technology space at my old investment bank, Needham & Company. And we participated on that IPO in 2010, and that was the second IPO for SS&C. The company was founded in 86, went private in 05, and went back out again in 2010. My conversation with Bill was primarily around strategic M&A. We covered management principles, and we spoke a bit at the end about SS&C's Singularity Initiative, which is an initiative around artificial intelligence and machine learning. And if you know back office, middle office environments, I, for one, started my career in the back office back in the mid-1990s with Putnam Investments. Much has changed. You could also say there's a lot that has not changed. The way I would describe back office, middle office is that we've seen the first wave of automation. The next sort of mega trend in that space was consolidation on the vendor side. And SS&C is one of the largest vendors remaining. The largest, certainly, back office. Middle office, you're competing a little bit with Bloomberg on the order management side, execution management side. But SS&C is very much the industry leader when it comes to portfolio accounting systems, trade settlement systems. I think the next wave, the next automation wave, if you will, is going to be around artificial intelligence and machine learning to drive more throughput around trade settlement, portfolio accounting, and frankly to reduce, if not in many cases, to remove the human element entirely from the workflow, which means operating leverage. So we're not in the stock recommendation game. I left that life behind in 2011, but I feel like a bit of a flag bearer for SS&C and the remaining companies in that space because it is a space that's near and dear to my heart, given that it's where I got my start. And I think it's a space that's misunderstood in the investor community. It's not a space where you're going to find billion-dollar revenue companies growing at 30+%. It's not Facebook, it's not Instagram. But it is a space where once you sign a deal with a customer and complete that implementation, it's very sticky. You can expect mid-90s renewal rates for companies like SS&C. In the case of SS&C, the company's had a consistent history of delivering profitable growth, historically in the 40% range, talking about EBITDA margins. And 2018 was a big year for the company, essentially doubling the size of the company from a revenue standpoint with the DST acquisition, which was completed back in April of this year. The EZ acquisition, which was announced in July of this year. I had the opportunity to get to know EZ back in 2008 when they were part of Bank of New York and VergeX and contemplating an IPO. Companies subsequently split into two. EZ was acquired by private equity. And then the most recent acquisition was Intralinks, which is a secure communications platform, virtual data room used by deal makers in the investment banking space, PE, VC. And when I knew them back in 07, 08, they also played a little bit in healthcare with secure document delivery. And so based on my prior experience with the company and knowing that Bill Stone is a detail-oriented founder CEO, my assumption is that on these recent acquisitions, you'll see the company get margins up to the historical corporate margin over time. I would guess they're back up to a 40% EBITDA margin in the next 2 or 3 years. So if you forecast out 2 or 3 years' time, you have a company that's approaching $2 billion in EBITDA, and you put a 10 multiple on that, that's pretty attractive. Before I go, I will link to SS&C's Analyst Day presentation. I think they did a really nice job on the deck. So I'll link to that deck, and I may link to a couple of other articles from TEK2day that I think are are relevant to this podcast. Enjoy the conversation. And welcome to the CEO Radar Podcast. It's your host, John Mayetta. Happy to have with me this morning Bill Stone, founder, chairman, CEO of SS&C Technologies. And today we're going to talk a little bit about mergers and acquisitions, strategy around such. I wanted to highlight SS&C as one example of a company that's done M&A well in terms of generating ROIC, generating value for customers. And M&A has been a core piece of the growth strategy over the years and certainly since the most recent IPO back in 2010. So Bill, thanks for making the time today. I appreciate it.
John, good to see you again. Glad to be here.
So maybe we could start, Bill, at a high level. How did you get comfortable in thinking about bringing in entities that were external to SS&C into the company? How did you get comfortable with M&A as a growth strategy?
Well, I think, when we started, which is a long time ago, but, in 1994, General Atlantic Partners became a big investor in SS&C, and, the current CEO there is Bill Ford, and I think General Atlantic had a history of doing acquisitions with their portfolio companies. So I was able to see how they went about it. And then in a previous life, when I worked at Advest, which is a stock brokerage firm that was based in Hartford, we did 9 acquisitions. So you got to see, some ways I thought we did them well, and other ways I thought there were areas you could improve on. But most of it was about, do your due diligence, but if you don't feel like you can trust what you're buying, then don't buy it. If you believe you can trust what you're buying, well, then trust them. Doesn't mean you don't verify, doesn't mean you don't check things. Of course you do that, but people have to know that you're in their corner. You want them to succeed. If they succeed, we'll probably all succeed. So it's more of recognizing that they're not outsiders now. They're part of us.
So you mentioned diligence, but before you get to due diligence, what are some of the key elements you look for in terms of acquisitions? I think you mentioned some filters in an investor deck around value creation, cultural fit, timing. Are there other factors? Do you weight certain factors more than others?
Well, as in all of these things, it's important that you don't waste your time. So while we have a very broad funnel of what we look at, and if it has to do with financial services, we're going to look. Doesn't mean we're going to buy, and we probably only buy 1 out of 10, maybe less. But we look at them all the time because we get knowledge, right? You get to see how places operate, you get to see how they price, you get to see how they go to market, you get to see how they package their products, you get to meet their management teams, you get to evaluate, their people. There's a lot of good stuff in casting a broad net around acquisitions, and the senior people at SS&C all know that I expect them to look at a lot of them and make sure that our experts in any one of our business are the ones really driving whether or not we would acquire, right? So, I'm not going to have Rob Rowley, who came in with the Advent acquisition, I'm not going to put Salentica in his business. He's going to want to put Salentica in his business. And then he gets to sort of pitch or defend why and at what price. And then we, together go see if we can close it. And I think that's the attitude we have. That's what gives us the breadth that we have, and also gives us the integration capabilities. So when we do multiple acquisitions at a time, a lot of times they're going into different people's businesses. So the other businesses that make up SS&C are often unaffected other than cross-sell and upsell opportunity.
Most of your business is in financial services, capital markets. Extrapolating out on what you said, that would imply that going forward, maybe the preponderance of acquisitions would be in capital markets and so forth. DST brought you a piece of business outside of capital markets and healthcare. So to what extent do you think about adjacencies and verticals that are maybe outside of capital markets where the senior execs inside of the company maybe aren't thinking about those opportunities in their day-to-day business?
Yeah, again, we cast a pretty broad net. So, financial services, if you look at it broadly, treasury departments of industrial companies, insurance companies perhaps, the health and wealth kind of paradigm, and then the ability to do transaction processing where we're a very efficient processor. We have a very efficient operations both offshore and onshore, and we grow both. And so we're constantly, striving for increased expertise that differentiates us from our competitors. This is not commodity. This is not corn. This is not wheat. You're not bringing it to market, and yours is the same as everyone else's. This is how well does somebody really understand EITF 9920 or understand some component of GDPR or IFRS or 52 other rules and regulations that we all are subject to. So our core competencies are tied around an expertise in accounting and financial reporting and tax reporting and performance measurement and compliance and risk. So there's an awful lot of things that make that up, and it takes time, it takes education, it takes training, it takes experience, and I think those are the things that have tended to make us increasingly a place people want to come to work. We've had some success in the value of our company and in our stock price, which obviously we have very large equity programs for our people, and we're also still very much into stock options and nothing else. You get granted at the price that when you came in here, and just like everybody else, that stock price goes up. We all benefit, and if it happens to have a dip, then we have to work hard to make it go back up, and that's kind of how we have the whole organization set up, and it's been successful. There's been a lot of people that have made a lot of money, and that's pretty rewarding too.
Now, a lot of what you just mentioned in terms of the businesses you participate in, there's a lot of deep domain expertise required to provide the services that you provide. Is the mission critical nature of your business, does that mean when you're looking at the acquisition landscape, do you look at businesses that have a mission critical element to them? Is that an explicit filter, or is it just something that's ingrained in the culture and your folks know that when we're evaluating potential acquisitions, we're going to look for companies that can bring in a mission critical element that maybe we don't have today?
Yeah, I think we would say, how do you define mission critical?
Okay.
So our view on how you would define mission critical would be much more, what are your retention rates, right? Generally, the more mission critical it is, the more your retention rates are very high, right? Because they don't want to change, and obviously in the businesses we're in, that you've been in and are in, it's highly profitable businesses, right? So that if these various money managers and other players in the markets, whether it's an investment bank or someone else, if they can get the assets, if they can get the transactions, if they can get the deals, it's pretty lucrative. So as a supplier to them, as a service provider, service partner, our fees become, they're not de minimis, but somewhat de minimis compared to a 2 and 20 or a, 175 and 1750 or a 3 and 30 that some of them try to charge. So then when, our 10 or 15 basis points seems to be, pretty modest. So they want very high service, and if you give them very high service, then our retention rates are very high, about 95, 96. And the kinds of companies we buy tend to be in that kind of retention, and I think that's how we would define mission critical.
When you're looking at targets, is the quality of the management team an explicit filter? Is it more about track record of that target? Do you look to bring on management teams that once inside SS&C, they can scale without much help from corporate?
Yeah, obviously, the management teams are a very important part of the acquisitions that we do, although we would say we're expert in almost all the acquisitions that we do. We're already expert, right? So you're not really going to teach us very much about an investment accounting system or some financial reporting system or even a virtual data room, right? We've done 50 acquisitions. We've been in lots of virtual data rooms, right? So if we've done 50, we've probably looked at 1,000, right? So there's an expertise that comes about it with that much experience. And so when you look at the management teams, a key decision criteria is, are they going to stay? So if they're not going to stay, it loses a little bit of its criticality to our business. What we have to see is okay, what's the next level of management, and how talented are they, and have they been there for a while, and they're really trying to crack through, but they can't because maybe the current management team has been there for 5 or 10 years, and they have 10 or 15 years to go, and so there's a layer of talented people that need some options, and then if the senior team leaves, then we have a built-in farm team that's ready to take over. And obviously you also have all the savings that you just got with that senior team leaving, so that you're able to reward this next team, and you have enough money that if you need to go out and hire 1 or 2 to supplement, you can do that as well. And so it's always measuring that. In a lot of ways you look at what kind of golden parachutes does the management team have in their employment contracts. So if they have some huge golden pair, they're quitting. You're not going to be able to convince them to stay. They're going to quit, and not because they don't like us or anything, and they're not nice about it. They are. It's all nice, but they're taking that money. I don't blame them. I think sometimes they could make a lot more if they didn't, but that's not for me to decide. That's for them to decide. And so, we're much more sanguine about the management teams, and we're very supportive of them, and we have many that have come to us that have done tremendously well, that are running big parts of our business, whether it's Rob Rowley or Mike Slidehome or Ken Fullerton or Christy Brimner or a host of others that have done just a great job taking over various different churches. Jeff Shorman at EDS, we've already given him another $30 million business to supplement the EDS business. And Leif O'Leary, we have high hopes of being able to really build out what he's done at Intralinks, and there's a host of people at DST that are in the boat with the oar and understanding that you get to go walk down the mountain too, right? It's not all uphill, so it's building that confidence that we can win too. We can catch a pass.
Yeah.
It's like teaching your son or daughter to kick a soccer ball, or something is that great job. Hey, that was really good. Whether or not they fell down when they were kicking at it or whatever, they need to have confidence that you believe that they can make it. And that's what we try to impart to people is confidence. Take chances. Hey, occasionally it's gonna blow up in your face. You're not gonna like it. Now, I'm not gonna like it either. But that's a rite of passage. And I'm not going to tell you every time. There's things I'd say, hey, John, I don't know if I'd do that. But you're convinced, and I'd say, well, go ahead. I've done it a couple times. Didn't work out well for me, but you might have a different approach. And I'm all for you. I hope it works. Usually you come back beat up and burnt, and you say, wow, that didn't work very well. Yeah, that's kind of what happened to me when I did that. But a lot of times you only learn when you do it, not when I tell you about it. I tell you about it, you say, you old fogey, you just did it wrong. It's okay, I'll buy that, but go take a shot, and a lot of times, you're trying to, if it's great big, I'm not gonna let you crash that train. We're gonna have more debate before we do this, because I'm gonna explain to you every step that I got clobbered, right, before you go out and do the same thing and get clobbered at every step I got clobbered. If we're gonna get clobbered, let's get clobbered a different way this time, right? Let's not do it the same way. And that's, again, that's an experience and an understanding, and then also a respect that people have different approaches. Things work, that they can pull things off that I cannot. I might be able to pull some things off that they cannot, right? But that's kind of the beauty of having a talented team and letting people have their own approach at how they're going to go about for success. And SS&C is a numbers-oriented place, somewhat maniacally. How's your numbers? Because that's universal. It doesn't have to do with Stone or Maeda or Canwar or anybody else. How's those numbers? We all talk in numbers, and so there's no politics. It's just numbers. How's those numbers? We're trying really hard. I understand you're trying really hard, but how's those numbers? Right? Let's don't get into all the adjectives, adverbs. Let's get quantitative first. Then we'll get qualitative. But if all you're doing is qualitative, then all you're doing is really hoping, and you go very many quarters of really hoping as a public company, and you're not called a public company anymore. You're called a division. I don't know who we're going to be a division of, but, and it's just that, that is the nature of, public company management. And a little bit it's, for private equity firms that own businesses, it's pretty much that way too. A lot of people will complain about short-termism and 90 days and, management's ought to have a long, management's jobs are to hit the numbers in 90 days and plan for the long term, right? So you have to have a profitable enough business to hit your numbers and plan for the future. And that's your job. There's no one or the other. One or the other, you get clobbered. So again, and I'm not saying that we have the perfect formula in every regard, but we're very cognizant that, we have to do this quarter, and then what's feathering in quarter, 4 quarters out. What acquisition did we do that, hey, like at ES, they have a new product called Eclipse, and they're very excited about it. They've got about 55 customers that are coming online, and they spent a lot of money to build it, and it's pretty slick. But okay, so how's the numbers going to work out, Jeff? Right? How's the numbers? And Jeff Shulman's a very talented guy, smart guy, and so we have a lot of optimism. But okay, we're going to put $25 million in new revenue in Q3 next year. We're going to put $35 million in Q4. Or how much? And now it's holy cow. Now you're really talking about So how do we get to that $35 million? Is that 100 clients? Is that 300 clients? Oh, it's 800 clients. Well, how many salespeople you have? We got 4. Oh, each one going to sell 200, huh? Probably not very likely. So again, it comes back to numbers. How many people do you have? How much can they do? What's a range? And if the number of times I've ever gone into a place and sold a system, that one time, it was for about $18,000, and it was about 20 years ago. I almost fell out of my chair. Guy wrote me a check for $18,000 right there. I went, this has never happened before, and it's never happened since. So it's a longer period, right? And you're talking to CFOs and head of investment accounting or head of trading or head of compliance or head of internal audit or 52 other people that come into the process. And so, a short sales cycle is probably 90 days. And a long one's probably 18 months, maybe more.
So a couple things in all of what you just said. You're experts in what you do. Therefore, if I'm an investor and I'm new to the story, that maybe suggests that there's a plug-and-play element to your acquisition. So you sort of just de-risk the story a little bit around your comment of being experts, because you can just, to an extent, drop acquisitions in and almost hit the ground running immediately.
That's right. So, we buy Advent, and it's good, really good company, and Stephanie DeMarco started it in, I think, 83, and she's a very bright lady, and built a great business, but it's investment accounting systems, and trading systems. So we've been doing this for 30 years. You know what? You do double entry bookkeeping different than we do double entry bookkeeping? I don't think so. You have a balance sheet different than we have a balance sheet, or an income statement, or how you do amortization or accretion, or how you collect dividends, or it's the same. Hey, we all have our systems, and we want to show you our security master and how brilliant it is. I tell our salespeople all the time, our security master looks like all of our competitors' security masters. So if you think you're going to sell based on showing them that security master and that you can pop up a window that has all the S&P ratings in it, everybody can do that. So you better have some differentiators besides, and I don't know, John, I think we have about 1,500 CPAs and chartered accountants that, add to that bulk of expertise. And so, we have a couple hundred CFAs, and we have actuaries and mathematicians, and so it's an expertise-driven game, and it has to be done where, the service offerings, the technology, the training, the overall, relationship that we build has to fit with our clients. And, we have to do a consultative way of nudging our clients into doing it the best way. Now, best practices and Six Sigma and all those things have kind of taken a hit on the chin with GE having its challenges. Sure. But at the same time, you do want to do things in a way that kind of optimizes how that client uses their information and gathers their information and reconciles their information and then gets ready for the next day, or ready for the next month, or ready for the next quarter, or ready for the next year, right? You're not doing tax returns every day. You do quarterly tax filings and you do yearly tax reports, but you got to be ready. You can't sit there and, it's April 14th, you go, hey, we have to file taxes tomorrow. Well, that's a problem. So there's a lot of stuff like that, this is the business we're in. We know that already, and if the client's not ready, gathering stuff in January, they get increasingly more inquiries from us. Where's your income? Where's your where are the expenses? Where's your tax income statement? What deductions are you hoping to get? And making sure, look, you can call those dividends return of capital if you want, but what those companies are going to send to the IRS is they're not returns of capital, they're income. And so you have to be able to understand that paradigm and then be able to help them be able to conform and do it in the least costly way as possible. But some of these places are big. Some of the big hedge funds we have might do millions of trades a day. So there's lots of data that needs to get processed, collated, reconciled, and delivered, and it's constant. So you don't get to take a day off. You take a day off, you just got double the amount the next day. What a trader that doesn't know their positions doesn't trade with confidence. And trading's a confidence game as much as it is a talent game. If you act with confidence, you're going to have a way better chance of succeeding than if you're timid. People that talk about really, really good traders, you don't hear the word timid very often.
A moment ago, you spoke about sort of the autonomy that you give your business leaders internally, which would suggest the speed of decision making. I always think of SS&C as a fast-moving organization. I think a misconception that people may have about some of the services you provide, back office, middle office, that there may be technology light, and that's not the case. You're doing a fair amount of work around artificial intelligence, and you have an initiative that Norm is spearheading. I was thinking maybe we could wrap up with what you're doing around advanced technologies that may cut across the businesses, such as artificial intelligence and machine learning.
Sure. So, I started this business in 1986, and if you go back, and I know a lot of your listeners will maybe not even have been born in 1986, but if you go back to that period of time, it's 1981 is the IBM PC, right? And they had given Microsoft the operating system, so MS-DOS became the operating system for the IBM PC, and also Dr. DOS, but Microsoft obviously won that game. And by 86, when I started, you're up to about the Pentium chip. So you had the 286, the 386, the 486, and then they called the 586 the Pentium. So the Pentium was the thing that really became the guts of a server and created like client-server architectures, which even today, primarily, things are client-server architectures. And whether you do it wireless or you do it hooked into, hardwired into your various networks at work or into the internet or intranet or all this other stuff, it's all been about the same. Even the cloud, right? That's a new name for the internet. And always remember the tech companies were about the best marketers there ever was, right? So often you might get undocumented features in some of the technologies that you use, and it's always unfun to find undocumented features. But so if you fast forward to now, and why that matters is that I really think since about 1986, 87, when we started building systems in large scale, till now, they've all been about the same. SS&C system, which are Camera and Porsche and Maximus and Trade Through and now APX and Geneva and Axis and a whole bunch of other ones, high portfolios. Similar, very similar, as would be SimCore and Eagle and Princeton and a bunch of other ones, very similar. But today, it's changing, and it's changing really fast. And that's because artificial intelligence, machine learning, intelligent process automation and robotic process automation, it's kind of taking the human element out. So if you think from 86 to now, and you thought about an analogy like toll takers, over the last 10 years, probably even a little longer, you start getting Easy Pass. And, you then, for a while, you started seeing fast lanes, Easy Pass fast lanes, where you could go 15 miles an hour through the toll. And then you could go 30 miles an hour. Now you can go as fast as you want and they charge you, right? There's no humans. So that's what's happening with technology today. And, with our Singularity initiative, we have embedded some of that into Singularity, and, love to show you and your colleagues, but you'll see it do work. You'll see it fix breaks. You'll see it highlight various anomalies in your data, and it's constantly, you'll see that it learn. Like it will learn that, hey, if you're clearing a break with US Bank, here's how they structure their records. And if you're clearing a break with HSBC, here's how they structure their records. And if Singularity sees HSBC the first time, okay, it'll fix that. But the next time it sees HSBC, it already knows. Here's how the data's going to come in. We're going to be ready. It's going to go real fast. You can see 100 breaks clear like that. And so there's a lot of things that this new technology does that really wasn't able to do until those technologies and the underpinnings of the infrastructure was fast enough to do it. So, some people wonder about having trading systems in the cloud and stuff like that, but this 5G network is coming on now. It's going to be really fast. All the things that we do today, with our iPhone or our iPad or one of the other, the Samsungs or any of the other ones, I think is you do so much more today. You would be willing to put a trade in your iPhone, and you probably have,
sure.
As have I, and 10 years ago, I don't know, because you get that little hourglass going for too long, and you just don't like having, you think a trade's going to process, especially a market trade in, a sub-second or a second, and you go 30 seconds wait, you start getting a little bit nervous. But today, it comes back that fast, and so those kinds of things then create confidence. I use an analogy. I I bet my son $50 on a football game. If I lose, I give him $50. If he loses, he says, "What's your Venmo account?"
Right.
What's Venmo? I gave you a $50 bill. I'll take 10 fives. I'll take, two 20s and a 10. Venmo. So, the world's different, and that generation, 2-day settlement, 48 hours. They're not going to put up with that. They think, we're just a bunch of dumb old bozos, and so, the things are going to change, right? It's going to be trade and settle. Yeah. It's going to be have your collateral, have everything ready, and these new technologies are what's going to allow you to do those kinds of things and have confidence that it's accurate, and that'll be a paradigm shift for all of financial services and, places like Wall Street and the city and other big trading venues and financial centers are going to be a lot different over the next 5 to 10 years, I think.
Bill, do you partner on the machine learning side? So at that core layer, do you build your stack on top of Microsoft, for example, or Amazon's cloud? Or
well, we use a lot of different technologies. We have our own development people and our own AI experts and ML experts and all of that. But whatever we can get commercially that we can build upon, we do. But in one instance, we rolled out a product just a couple of years ago that took what was taking a major international bank 4 hours a day to do, and when we turned it on, it took 3 seconds. So
that's value add.
Yeah, that's value add. But that's the power of computers,
yeah.
Right? They can do things really, really fast. And if you get it set up right, they do it really, really fast and really, really accurate. If you get it set up wrong, they still do it really, really fast and really, really inaccurate. So, it's important that you have the testing and have the decks and understand, wherever the weakest points in the chain are, and make sure you don't have single points of failure and all that kind of stuff. And, being an old auditor, I'm a kind of a control freak. It's, hey, wait a minute, how do we know this? What's our process that makes this work, right? Not just that somebody tell, oh yeah, it works. Oh, okay, I don't mean I don't believe you, but I want you to tell me how does it work, right? And why does it work? And does it work at 2,000 trades? Does it work at 20,000? Does it work at 2 million? What's the throughput? What's the capability? And those kinds of things are better learned up front than learned after you're in installation mode and you hit go and it goes too many trades. That's a bad day.
Bill, I appreciate the time. Thanks very much. Thanks for joining the podcast.
Okay, John. Good to see you again.